Gold is currently trapped in a high-stakes whipsaw, oscillating between a total collapse and a sudden, sharp recovery. This chart shows the scale of the volatility, beginning earlier this year when gold reached an all-time high of $5,589 an ounce. That momentum vanished during the Iran war sell-off, which triggered a plunge so severe it erased every dollar gained in early 2026. Silver investors faced an even steeper decline, watching the metal crash 7% over that same window. Prices have since clawed back a portion of those losses, with spot gold currently stabilizing near the $4,315 mark. This cycle of rapid expansion and contraction suggests that success in this market depends less on the ultimate direction and more on whether a portfolio can withstand the volatility required to reach the target. The recent price momentum follows a sequence of geopolitical headlines, moving independently of the usual economic reports. This rally began with a specific post from Donald Trump and accelerated the moment the Strait of Hormuz officially reopened. Within 24 hours of those events, bullion jumped nearly 3.6% to approach $4,370, while silver surged 4.9%. These news-driven daily spikes remain well below the structural year-end targets of $5,400 to $6,000 set by major institutional desks. An entry at $4,315 represents a choice to accept short-term portfolio instability in exchange for long-term geopolitical insurance. Geopolitical headline risk currently serves as the primary driver for these price movements. The next test arrives Friday in Switzerland, where a high-profile diplomatic signing event is expected to trigger another round of market activity. Relying on these events is high risk. News that causes a morning surge can easily reverse by afternoon, leaving positions exposed to heavy drawdowns. In the background, Federal Reserve policy provides a second, equally significant layer of influence. This matrix shows a shifting expectation. CME data indicates December rate hike probabilities fell from 70% to 57%. Lower expectations typically provide a price floor for gold, becoming more attractive as interest rate pressures ease. This floor remains fragile, as a single high inflation report could immediately restore those hike probabilities and remove the current support level. Looking beyond the daily charts, major financial institutions are focusing on long-term structural targets. This scorecard shows a bullish outlook for the remainder of the year. Goldman Sachs forecasts a climb to $5,400, while JP Morgan targets $6,000. While daily headlines drive short-term spikes, these bank targets rely on the steady, quiet accumulation of gold by global central banks. Adopting this long-term view requires a wide time horizon and the emotional discipline to ignore temporary market noise. The market reaction to the May jobs report illustrates this challenge, as strong data caused sharp, sudden drops that forced many short-term holders to panic. Utilizing these institutional targets requires looking past tomorrow's price action to focus on surviving the macroeconomic journey through the end of the year. This decision tree shows that the 2026 gold market is effectively two different environments, depending on your primary objective. For those prioritizing short-term trading and alpha, the rules of engagement are dictated by immediate volatility. Your strategy centers on the Wednesday Fed decision and the shifting 57% probability of a rate hike. This approach requires strict stop losses, as it involves trading on headline risk rather than the metal's underlying long-term value. Tactical traders can use this extreme volatility to their advantage, but it demands constant monitoring of the geopolitical news cycle. The long-term hedge branch applies to those using gold for wealth preservation and strategic accumulation. Success in this segment requires ignoring daily fluctuations, including single-day jumps in gold or the 7% drops seen in the silver market. The focus remains entirely on the gap between today's $4,315 entry and the projected $6,000 year-end horizon. Regardless of the strategy chosen, the current market environment guarantees a difficult and rocky experience for any participant. The path to $6,000 is a contested warpath, shaped by macro policy and global conflict. Managing this risk requires sizing your position to match your tolerance for volatility and bracing for the impact.